In Chapter 6, we're going to study the concept of GDP and how it relates to measuring progress. And we'll cover the basic ideas: what is GDP, growth rates, the difference between nominal and real GDP, cyclical and short-range changes in GDP, the different ways you can split GDP up when you analyze it, problems with using GDP as a measure of output and welfare, and we'll sum up at the end. So the intuition of GDP, gross domestic product, is that it's an approximate way to measure a country's standard of living. And if we track GDP over time, we get a very approximate but useful measure of how a country's standard of living has changed. Now, when we measure GDP, we have to be careful to adjust for certain things. And we'll get to those things in a little bit. Now, just to give an example of how GDP is really informative, take, for example, what happened to India's real GDP per capita between the years 2000 and 2010. India's real GDP, real means you adjust for inflation, and per capita means per head. So real total production per person grew at an average rate of 7% per year for 10 years. Now, when you have a multiplication effect of high growth compounded by more high growth, and that's compounded by growth, you can increase very quickly. And that meant that on average, the standard of living in India increased by 100% in a mere 10 years, which is a really, really big deal, not just for India, but for the world, actually. Here you see a chart showing the growth rate of real GDP per capita in India over an extended period of time. Now, this is real, so this is not biased by inflation, and it's per capita, so this is also adjusting for population size. And if you maintain a high rate of growth over a period of time, what you're going to get is an exponential shape, exponential growth. You don't just track a certain amount better and better and better, you actually go faster and faster in your growth, as long as you're keeping that real growth rate at the same. So the sort of image that perhaps a lot of us might have as India being a poor country, well, if you go back to 1980, yeah, that's pretty true. But India has gone way beyond that. So you see that big jump there toward the end. Real GDP per capita doubled. In this chart, the period is a little different from what we talked about. In this chart, the period is from 2003 to 2014. It's important, by the way, anytime you look at this sort of growth rate chart, that you carefully look at the vertical axis. Now, this vertical axis is using a uniform scale. Each notch is increasing by 1,000. And that's one way to draw the diagram. I should mention that another way you will see of calibrating vertically when dealing with growth rates is to use what's called a logarithmic scale. And with a logarithmic scale, when you move up each unit, you are not going up by the same amount quantitatively. You're not going up by 1,000 to 2,000 to 3,000 and so forth. If the scale on the left happens to be a logarithmic one, not this one, but a logarithmic one, then each jump is a multiple. So instead of going from 1,000 to 2,000, 3,000, 4,000, you'd be going like from 1,000 to 2,000, 2,000 to 4,000, 4,000, jump all the way to 8,000, 8,000 to 16,000. And I'm bringing that up because when we look at any data to do with growth rates, we sometimes use a logarithmic scale. Not this time, but sometimes we do. Here's a definition of GDP. GDP, gross domestic product, is the market value of all finished goods and services produced within a country in a year. And GDP per capita means you divide by population to get a kind of average number per person. Now, if you look at this definition, it looks very straightforward and sort of no big deal, right? Kind of obvious, but it's not quite so simple as it sounds. You'll notice the definition of GDP uses the phrase market value. It uses the phrase finished. It uses goods and services and then produced within a country. And all of those things are very significant. Market value means that the goods and services we're focused on are goods and services which enter some kind of national market. They're traded, they're bought at a store, they're bought at a supermarket, they're bought when you go to the dentist. You know, there's an exchange between strangers, basically. Strangers are trading with each other. Their trade occurs within the context of a market, which means that demand and supply and some sort of equilibrium exists. So the valuing of the finished goods and services is to some degree objectively determined by this impersonal market. If you have a country that does not have markets where everything is directed and controlled from above and there's no demand, supply, adjustment of prices, anything like that, if prices are decreed by the government, then you cannot trust their reporting of gross domestic product because there's no market value to sort of set the value. The government could be setting the value of the finished goods and services at whatever it likes. So the market value thing is not a kind of trivial, minor thing there. And another thing about market value means it's it's philosophically trade between people who are not part of the same unit. In other words, it's not trade between members of the same family. So you mow your lawn and the rest of the family prepares your breakfast. That is a sort of an exchange in a way, but that does not enter into national GDP. The family unit is a unit within which we don't kind of care what goes on. So services that one part of a family does for another part of the family does not count for GDP because it's like you doing something for yourself. It's like you making breakfast for yourself. The rest of the country doesn't care. The rest of the country doesn't care that you're a great cook, but you're not a restaurateur. You don't provide meals for the rest of society. You're doing it for yourself or your family. That's great, but that does not count for GDP. And notice it says finished goods and services. Now, what that means is basically goods and services which are traded in their kind of final state. We don't include what we call intermediate inputs. So the cake shop that buys cake supplies like dough from somebody else, we don't count the inputs the cake shop purchased as part of GDP, because we figure that all that other stuff is implicitly being counted when the cake shop sells its cakes to its customers. Everything is included at the final stage, and that's when it gets measured, and that's okay. Now, there's some kind of complications in figuring out how this works. If one rule is that certain sorts of capital, by capital we mean the produced means of production, like a tractor. When a tractor is built and sold to a farmer, we count that tractor sale to the farmer. So we don't count the tractor the farmer uses as an intermediate sort of product that will get counted later. So there's a little bit of kind of accounting rules here. And just assume, just like in accounting, there are certain rules and they all make sense. And the rules are, we only count finished goods and services. There is some logic. We don't want to double count things. We don't want to double count the corn or the wheat that gets used at multiple stages on producing a cake. But we also have a rule that the machines and other tools that are used in production, they're actually counted when they're sold to the final user, who in this case is the producer. And we choose a year, obviously, because then we don't have any seasonality issue. So we go from January through December, that's a year. We've gone through every season, and then we're about to repeat. So just like everything else in the world, 1 year is the normal basis for our measurement. And finally, the produced within a country idea is we're counting production that literally occurred within a country. So if the United States owns a factory in Canada, the production of that Canada located factory does not count for US GDP. And I'll give you the intuition. The intuition is we sort of want GDP, as well as being a measure of prosperity, to also be a useful tool to explain employment. We want a GDP number that helps us figuring out why there are more jobs or less jobs. And production that occurs on the territory of the United States contributes to United States employment. Production by a US company in a different country, their operation is in, I don't know, Mexico, say, that is good for certain reasons for the US. It is good for the US, but when it comes to employing US people, a factory located in Mexico doesn't count, even if it's owned by an American company. So there is a sort of logic of that definition. The market value, so we have independent prices, and we're only counting trade between strangers, not within the same family household. The market value of all finished, in other words, we count at the end of the production cycle. Goods and services, that's another thing I should have brought up as well. Services are on an equal footing with physical goods. So the baker who makes a cake and the dentist who, looks at your teeth, or the person who cuts your hair, the services provider and the provider of tangible goods are treated on an equal basis. Now, that's relevant because way back, decades ago, when there were planned economies like the Soviet Union, they gave way higher priority to producing physical goods. And they didn't care that much about services because they figured finished goods, building houses, building stuff like that, that's good, that's real progress. Providing the regular citizen with a decent haircut, that's sort of not a big deal. That's not really what an advanced society cares that much about. But for us, We don't care. If you spend most of your disposable income on services and you don't buy a lot of other physical tangible goods, that's your choice. We figure you are going with what you value. So we don't have a hierarchy there. Goods, services, and also goods and services employ people. So the factory worker and the hairdresser, for GDP purposes, they're treated as exactly on the same category. We don't prioritize one kind of producer or worker over another. Market value, all finished goods and services produced within a country in a year, and of course, to get a sense of how better off the regular person is, we divide by the size of the population, GDP per capita. So here's an example of why we focus on production occurring literally within the United States. And as an example, suppose there's a Canadian-owned factory located within the USA. We count that for US GDP, not Canadian GDP, because the jobs were created in the USA, not Canada. There is a concept called net national product that uses the ownership rule, but that's for a different purpose. Net national product is used for studying trade flows between countries and movement of foreign exchange, that is to say money between countries. And the Canadian factory located in the US is sending profits back to Canada. And if we're interested in international money flows, then the ownership of the factory clearly matters for flow of money between the US and Canada. Now, we are not going to study net national product. I only bring that up to explain that we do have a different concept which factors in the ownership of factors of production like a factory. But when it comes to GDP, we don't care who owns the factory. It's creating jobs within the US. It could be owned by Martians for all we care, for employment purposes. So for measuring GDP, we're adding up millions of different final finished goods and services. And of course, some goods are more valuable in the sense they sell for a higher price than others. So clearly you cannot just add quantities. And how could you do that anyway? Because you're measuring cars and you're measuring tons of wheat and you're measuring tons of iron ore. So we need a common measure, and the common measure is dollars. And as referenced before, the particular dollars we count are the ones that show up in the market as the market values or market prices, that is, to measure the value of trade and the value of the production that occurs. So the hairdresser, we use the value as our estimate of value. We use the price that the customer pays for a haircut. And for a car, a new car, we use the value of the new car that for what it sold. And that way we can add up and have some kind of rational measure of the value of all the different sorts of things that are produced. So an intermediate good is a good that's sold to a firm or whoever the sort of final seller is, and the intermediate goods are mixed together, bundled, processed, and they generate ultimately the final good or service. And the final good or service is called the finished good or service, sold to the final user, or held in personal inventory. So you can produce a good and the user buys it, but sort of just keeps it, doesn't do anything with it. We don't care. The good was produced during a particular year. It employed people when the production occurred. If the final user buys a new car and doesn't actually drive it, that doesn't matter. It was that the final sale occurred. So hence, only finished goods are included in GDP. And as I mentioned before, machinery, equipment used to produce other goods, those are included in GDP directly. And think of that as just an accounting rule. Now, when we speak about the service sector, we're actually speaking about the sector that has the dominant position in production in the United States. If you see the chart there, when you go back to 1950, the services sector was only 45% of the total production in the economy. But now, services constitute around 70% of the economy. So when we talk about GDP, our natural inclination is to think of physical goods like cars and wheat as being somehow the dominant subject of study, but actually in an advanced economy, more effort and more production occurs on the services side than the physical goods side. So GDP measures production, but the production has to have occurred within the year that we are counting it. And that makes sense. We want to count employment in the year when it happened. So resales, like old houses being resold, used goods being resold, movement of financial assets, those do not add to GDP. Now there's some technicalities. What about the work of the housing agent who facilitated the sale of the old house? Well, in that case, the work of the housing agent, the real estate agent, I should say, the real estate agent who helped sell the old house, that does get counted in current year GDP. But the old house itself is not counted as production this year. It wasn't produced this year. It was produced some earlier year. And as I mentioned, the US GDP includes goods and services produced by labor and capital located within the United States. We talked about that before. There's another concept called gross national product that's similar to GDP that also includes what's supplied by US permanent residents. And I'm not going to get into some of that technicality. That's another one of those accounting issues that for the economist are kind of secondary. So gross national product is the market value of all finished goods and services produced by a country's permanent residents wherever located within a year. So we need to get into the very important distinction between nominal and real GDP. Nominal GDP is when you calculate GDP using the prices at the time of the sale. So if GDP in 2016 is calculated using 2016 prices, we call those prices nominal prices. If GDP in 2000 is calculated using year 2000 prices, that's nominal GDP. Now, if we are going to compare GDP over time, there's a potential problem, basically because of inflation. Inflation is the reason for the potential problem. If the nominal GDP increases, but it was due to increased prices, I should say inflation would be better way to put it, then that increase in nominal GDP was not actually a real increase. It was just prices being higher. So we want to have a way to cancel out the inflation effect. And especially when we're comparing GDP in different years, we want to be using the same comparable dollar measurement. The concept of a nominal variable applies to all kinds of variables in economics. A nominal variable is a variable such as nominal GDP that have not been adjusted for changes in prices. And if you have a variable like real GDP that has been adjusted for changes in prices by using the same set of prices in all time periods, we call that a real variable. A real variable is one where the inflation effect is not an issue. So the top row here shows a straightforward situation of nominal GDP. 2016 GDP was measured by taking 2016 prices and applying those to the quantities of the things that were produced in 2016, and that gives a number of 18.6 trillion. So that's what we call a nominal GDP measure. And if you do the same thing, but in the year 2000, you take nominal GDP by taking prices as they were in the year 2000, and you multiply that by the quantities of the different things produced in the year 2000, you get a number of $10.3 trillion, and that is a nominal GDP value. Now, if we try to compare the growth in GDP between 2000 and 2016, and if we just use that top row, what we'd show is a really big increase in GDP of 81%. But remember, we're not comparing apples with apples because the prices we're using are not the same prices. For the 2000 production, we use 2000 prices. For the 2016 production, we're using 2016 prices. So what if there was a lot of inflation between the year 2000 and the year 2016? You could have a situation where the real production in 2016 was actually exactly the same stuff as in the year 2000. But with inflation, that nominal GDP number for 2016 would be bigger. So we need to do something about it. And the obvious way to do it is pick one year and use those prices for both GDP numbers. So you could take 2016 prices, of course you apply those to production in 2016, but also apply the 2016 prices to the production in the year 2000. And that way you're comparing apples with apples. You're using the same measurement. You're a rule, you're using the same tool, the same instrument to measure with. And so once you adjust for inflation by using 2016 prices, the increase in real GDP now was 33%, which is still a good number, but it's lower than what you get if you don't adjust for inflation. And in the lower sort of bar there, we used 2016 prices. It would be equally valid if for both years we used year 2000 prices. If we're looking for the percentage increase, as long as you're using the same consistent measuring tool, you'll get the 33%. So you can use 2016 prices as your benchmark for both years, or you could use prices in the year 2000 for both years. Either way, you're not going to have the problem of being kind of fooled by inflation. So one sort of tool we use to do deflation is to create a number called the GDP deflator. And really, the GDP deflator is the number you use to divide into nominal GDP for a particular year in order to get real GDP. So you can show the formula the way I've got it there. Another way to put it would be to put that real GDP on the left-hand side of the equality sign. You could move the GDP deflator underneath the nominal GDP there, and you could equally legitimately say the real GDP for a particular year is equal to the nominal GDP for that year divided by the appropriate value for the GDP deflator for that year. And the GDP deflator is like an inflation correction number. That's all it is. The GDP deflator is a number to account for the degree of inflation that has occurred since the base year, whatever base year you used, and you use that GDP deflator to cancel out the inflation effect. It's always easier to use an actual example instead of talking about the concept, right? So let's suppose we're talking about the USA, and let's suppose for the USA in 2010, the nominal measured that year value of GDP using 2010 prices was 10 billion. Now, obviously, that's way incorrect. US GDP is way more than 10 billion, but forget, just put that to a side. I'm picking an easy number here. So assume in the year 2010, nominal GDP in the US was 10 billion, and we're using 2010 prices to get that number. Let's go back to the year 2000, and let's suppose that in the year 2000, the nominal value of GDP in the USA was 5 billion, but that's measured in year 2000 prices. Now, can we look at the 5 billion for the year 2000 and look at the 10 billion for the year 2010 and say, awesome, that's a doubling of GDP. The US became twice as prosperous. Well, obviously not, because in 2010, the price of everything was higher. There had been inflation over 10 years. So we need to adjust for that. And it doesn't matter whether we use the year 2000 prices as the base prices for measuring everything, for measuring what happened in both years, or we could choose year 2010 prices to measure what changed between the 2 years. Either way, we'll get the correct percentage adjustment as long as we adjust for inflation between the 2 years. So now we've really hammered on this correcting for inflation. So here on out, we'll just talk about real GDP and assume we've made the suitable adjustments for inflation. So real GDP per capita, as said much earlier, is usually the best reflection of changing living standards. It's the best that's available. It isn't ideal. And if we just look at real GDP per capita, we're looking at growth in terms of the entire country. If we want to know what's going on with the population, the sort of average person's standard of living, then you have to divide by population in each year. So if you have a growing population, of course, you have to divide by populations to get GDP per capita. So you don't just get a big GDP because you suddenly have a bigger population. So there are two potential uses for GDP. One is you can do like we've been doing up till now, which is compare total real economic output in different years and compare over long periods if there's been growth. And if we do per capita, then we're adjusting for inflation, and we have some idea of whether the average person is better off, like the India example earlier. You can also use GDP to measure short-run fluctuations in the economy. And in fact, the National Bureau of Economic Research tracks that kind of number. And by following that, we can figure out, are we in a recession or a depression? The definition of a recession is a significant widespread decline in real GDP and employment. That's how we measure it. And here you see the data for changes in growth rates converted to an equivalent annual rate, what the annual rate would be if the rate in that quarter occurred for the whole year. And so what you see really clearly here is that in the economy there are booms. That's when employment is higher than the long run average. And there are recessions. That's where unemployment is lower than the long run value. And changes in employment track production fairly well. So what you can see is an economy, in this case US, has a long run tendency to have a lot of fluctuations. If you see the little blue, faint blue bars there that go from the bottom axis all the way straight up, those blue bars are designating what were officially classified as periods of recession. The Bureau of Economic Analysis, the Federal Bureau of Economic Analysis, made that determination. So you can see, for example, right after 1980, there was a serious recession, and there was one around like 1990, and there was another serious one 2010. So 1990, for example, was a sort of stock market crash, which was concentrated in the tech sector. So that's associated with all these companies that rushed into the internet, and they thought they could all make a lot of money by selling and doing stuff on the internet. And that was an interesting kind of recession. Not all recessions are the same type. The 1990 recession, although it was severe, it was also short, and in some ways it was a natural phenomenon that you kind of would expect in a healthy economy. There was this new opportunity called the internet. Lots and lots and lots of companies thought they could become really rich by doing various things. A small percent of those companies were actually right. They actually had figured something out that was really going to boom, like Amazon. And there are lots of other companies that had ideas that turned out to be terrible ideas. So that triggered a short run crash in 1990, sort of concentrated in the stock market. The people who were mostly hurt were the people who bought shares in the companies that failed. So actually the 1990 experience is sort of like the way capitalism is supposed to work. You have periods of excessive optimism based on something real, and the companies which really do a good job and are reading the times correctly go on to succeed. And a lot of companies that place their bets, the bets turn out to be wrong, the companies close, people get other jobs. And you can see right after 1990 the economy bounced back fairly quickly. Now the 2007 to 2009 recession you see there was even more serious than the 1990. And that's a different kind of recession, because the 2007 to 2009 recession was a financial crash. It wasn't caused by what we call a real event like the internet. It was caused by banks, or not banks so much, but a lot of problems with Wall Street and mortgages that failed, and it's a complicated story. The 2007-2009 recession is not the kind of recession that serves a useful purpose. It's more the 2007-2009 recession was more folly than a necessary, natural kind of flushing out of good ideas and bad ideas. So that's looking way ahead. That's looking way ahead to when we get to business cycles. But I just want to make the point that when you read this chart with these ups and downs, recessions and booms, there's a reason for the pattern. It's not random. It's driven by fundamental economic events, and we'll get to those events later. But we use GDP, coming back to the main topic for right now, we can capture those recessions and use real GDP. In this case, it's real GDP growth, actually, not real GDP absolute number, real GDP growth rates that's being measured, that it signals, tells us what was going on in the economy. And in that vein, a business fluctuation or business cycle is a short-run movement in real GDP around its long-run trend. So when you had the plus high rates of growth or low rates of growth in the previous diagram, that's what we're talking about as a business fluctuation. Now, there are different ways to calculate GDP, and there are different approaches. Two of the common ways are what's called the national spending approach, which means you add up all the components of spending. The other one is the factor income approach, which we will not use. The factor income approach basically looks at income that the factors of production earn, and we figure that income reflects what the production was. Now, we're not going to use that. We're just going to use one. Number one, national spending approach is more intuitive. And also the national spending approach makes it sort of more intuitive and clear that GDP is in effect measuring production. So the equation, which this is a very famous equation, y equals c plus I plus g plus exports minus imports. The y means national income or GDP, okay? There's no significance to it being y. Y is just the one that was chosen. Y is GDP. And forget about inflation, by the way. Forget inflation when we're doing this example. No inflation. Imagine a world no inflation. So Y is total production within a country, within a year, particular year, only counting finished goods and measured at market prices. Okay, total production of finished goods within a country measured y equals c plus I plus g plus exports minus imports. So the C here means consumption, so production of cornflakes. Okay, that's production of services. Okay, you produce and people consume services. So services, physical goods for personal purposes, that's all C. I is in production of investment goods. So in investment, we don't mean financial investment. We mean something like a tractor, an earth mover, an office building. So producing an office building employs people, just like producing wheat and selling it for people to eat employs people. So I counts. And G is government expenditure, building a bridge, building a road, building military facilities, anything which involves the government providing a service to people or producing a finished good of some sort. That counts as G. Now, one thing G does not include is what we call transfer payments. A transfer payment is where the government takes money from you and gives it to me, or vice versa. Moving money around, what we call transfer payments, does not get counted in G because it's not actually associated with producing a finished good or service. So we ignore G. Exports minus imports. Why is that there? Well, if we produce a car and export it, we are employing people. So it counts. It counts. We produce the car, we ship it overseas, and someone buys it. That's an export. That should count. Why do we subtract off imports? We subtract off imports for the following reason. Suppose we import a car from Japan and we start consuming it, using it. Then C will go up. We import the car from Japan, C goes up. That's a form of consumption good, but we know that that did not actually create jobs in the US. So we want to cancel that out. Imports are going to show up in C or I or G, but we don't want it to show up because it didn't involve production within the US. So that's why we have a negative imports term to cancel out that. One more technicality, and then we're done. I means investment goods, producing the tractor, the earth mover, etc. I also includes production of a good which is sold to somebody, but it's put into inventory. It's not being used. Now, we don't care actually that the good is not being used. The fact is it was produced this year, people were employed to produce it, so it needs to be counted somewhere, and the national income people just decided randomly by their discretion to count that as an investment good. They could have done it differently. They could have invented a fourth term as well as C plus I plus G. They could have also created something called inventory goods and put that in the equation. But they didn't. They put inventory under I. So that's a sort of technicality. And sometimes I get asked, well, okay, the car was produced this year, it was sold to the car dealer puts it on the lot, and they're not going to sell it until next year. Well, the car was produced this year, it counts for this year's GDP. It will not count for GDP next year when it's sold from the lot, because all of the production services were assigned to this year. And that's what national income accounting is. National income accounting is like accounting. It's not got that much to do with trying to meet economic theory. It's really just trying to measure accurately. So all of these terms are sort of like in this equation, it's sort of like an accounting equation. Now, there's one thing I want to say about the C plus I plus G plus exports minus imports. That equation causes some sort of difficulty, and there's a reason psychologically for the difficulty, which no textbook ever tells you, but I will tell you. The Y equals C plus I plus G plus exports minus imports equation is a little difficult to kind of grasp because it has a dual nature, a two-way nature, dual as in D-U-A-L, okay? On the one hand, that equation is purely an accounting equation. It's purely an equation for counting stuff up and making everything equal. And no problem there. But in economics, that equation has also been used as a sort of theoretical equation, like in the demand and supply model and stuff like that, for various reasons that I won't go into right now. This equation has sort of a schizophrenic aspect to it. It's simultaneously a pure accounting equation, and in that sense, sort of the invention of the terms was arbitrary. It could have been done differently, and you're just adding stuff up. But it also shows up, not for us now, but later maybe, it also shows up at being used as a theoretical concept like demand and supply. So this is strange because nobody ever uses accounting in business accounting as a form of management theory tool. I mean, of course, the data about what's going on in the business is used in making decisions, but the actual accounting equations per se are not regarded as being theoretical equations. So this equation can be confusing to people because it has this nature, and depending on the context, it's being used differently. Okay, so just be aware of that if you've ever had trouble with this equation before. So here we are again, y equals I plus g plus nx. Nx means net exports, or exports minus imports. And here you have more detail on what's included in those categories. And just remember, the G, the government's expenditure, the government purchases, does not include what are called transfers. Transfers of billions of dollars from you to me are not the same thing as producing $1 billion worth of roads. GDP has some problems if you attempt to use it to measure prosperity. And that's because GDP was not originally intended to be a measure of prosperity. It was simply a technical measure of production. So GDP does not count production which does not enter the market economy. Production that does not enter the market economy doesn't have a price, a market price. Therefore, it's not possible to value it. As I referenced before, if you take on the burden of mowing the lawn for your family's house, how on earth is that going to be counted when measuring GDP? So it's basically not even possible. And also, it's not a service to outsiders or strangers. It's kind of a service to yourself because we count the family as a single unit, or the household, actually, I should say, is the strictly more correct term. A single household is its own unit, and what goes on between members of the same household does not count for GDP, and it cannot be counted because it's not traded at market prices. Another problem is pollution. GDP does not count negatives or bads like pollution. Pollution just simply is not a form of production for which people pay money. The level of health of a nation is not directly measured by GDP. You can infer it by counting the value of medical services, for example, but that could just be a function of poor health. So really, GDP is not good for measuring a sort of general concept of how healthy people are in a country. And of course, illegal or underground market transactions are completely omitted. It's possible to guess what they might be, but it's not measured directly. But illegal underground market transactions are just not counted. To summarize, GDP per capita, adjusted for inflation, of course, is a rough estimate of not only total production in an economy, but the standard of living in a nation. And we correct for inflation by using the same set of prices in every year, by which I mean we evaluate GDP in different years by picking one year to be the base year prices that we're going to apply for every year of output. GDP has limits. It does not include goods in the underground economy, the value of goods that are difficult to price, the value of bads, like a bad environment, the health of nations, or the distribution of income. GDP is an aggregate measure divided by the size of the population, so it really has nothing to say about how equally income and welfare is distributed. And I should add one sort of postscript that isn't in the book, is that some people have tried to create alternative measures of sort of national welfare by including things like the distribution of income and health. And that's a worthy endeavor, but it's very difficult to create a consistent standard method of measuring those things that will work across different countries. Whereas counting up what is produced, valuing it at market prices, at least has the virtue of being consistent across different countries, and it's consistent over time. One last footnote is that I haven't really talked about this, but there are some other things, like the fact that new products get invented. So it's difficult to make an adjustment for the value of having new products, the value of having more reliable products than people used to have before. The one thing we can say, though, is those considerations, if anything, are going to tend to push our estimate of real GDP up in the same direction. So if our standard GDP measure is not correct exactly, we have to use some common sense to put it in its place and allow for the importance of other things. And that's it for this chapter.